Hello everyone, I'm Jack of all trades, and today we'll have a look at Cannibal stocks. If you're curious what they are, then please stick around and we'll have a look. I'll start the slideshow. So what are we going to cover today? Well, first of all, what is a Cannibal stock? Then we'll have a look at how it works. Then we'll look at some examples, and then we'll get to if you should buy them or not. It's good to know that I'm not a financial advisor, so everything I share is my personal opinion. Before you buy any stock or sell them, please do your own research. And while we're at it, I'm a new YouTube channel, so if you want to help me out, then please leave a comment, like the video, but the best thing is to subscribe so you'll stay updated with all the videos that I make. Thanks a lot, and let's continue. So what is a Cannibal stock? A Cannibal stock is a company that engages in aggressive share buyback programs. So like a real cannibal, a human that eats other humans, this company will eat itself. The profits from the company will go to buying the own shares back. The strategy involves the company purchasing its own outstanding shares. It effectively reduces the number of shares available to the public. So by buying the own shares, the amount of publicly traded shares reduce. The term cannibal is used because the company is metaphorically consuming itself by buying back its own shares. So how does a Cannibal stock work and why is it interesting to buy? Well, let's say we have a company that has €1,000 profit and it has 100 outstanding shares. In that situation, the earnings per share is 1,000 divided by 100 shares is $10 per share. But when the company decides to buy back 10% of the shares, so that's 10 shares, there will only be 90 shares remaining. So in that situation, if the earnings are still $1,000, then that $1,000 will have to be divided amongst 90 shares, which will make the profit not $10, but $11.11. But let's say the year after the company decides to buy back another 10%. So 10% of 90 is 9. So the outstanding shares that are remaining is still 81. So the new earning per share is going to be 1,000 divided by 81 shares is $12.35. So by looking at this, you can see that a company where the profit is the same every year, by buying back its own shares, it will eventually increase the earnings per shares because the same profit only has to be divided amongst fewer shares. So if you look at this effect over time, you will see in the graph on the bottom the amount of years that have passed, and on the left side the earning per shares in the same situation that we discussed in the previous sheet. So every year the earnings are increasing because the amount of outstanding shares are decreasing because they're bought back every year. On the right top you'll see the table and you will see the effect. So as you know, the first year there are 100 shares and you will get $10 per share for them. But after 20 years, the shares have been reduced to 14, and instead of $10, you earn $71.43. This is still the situation where the profit is exactly the same each year. The only thing that's changing is the amount of shares that the profit is divided to. So let's have a look at some examples. A famous example is Domino's Pizza. They're the biggest pizza company in the world, and they are a combination of franchises and by Domino-owned stores, and what they do is they sell pizzas. In the last 14 years, they've bought back more than 40% of their shares. So if there were initially 100 shares, there's only 60 shares remaining. So the profit per share has increased, just because of the reduction of the amount of shares. Underlying, the profits of the company have also increased, so that's a double effect. If you look at Visa, then you see something similar. Together with MasterCard, they have a duopoly in their field. They're in finance. And they also bought back more than 40% of the shares in the last 14 years. So same as Domino's Pizza, the profit that they make has to be divided amongst less shares. So there will be more profit per share. Probably the most famous example of a Cannibal stock is AutoZone. They sell a wide range of car parts and accessories, which by itself sounds very basic and boring. But this basic and boring company, they have been making a nice profit, and every year they use the profit, or a part of it, to buy back the shares of the company. So in the recent 14 years, they bought back more than 55% of the shares, which means that only 45% of the shares are remaining. So the profits that they're making in the future will only have to be divided amongst 45% of the shares that you started with 14 years ago. I also noticed that I mixed up the picture of AutoZone and Visa, so please forgive me for that. I think it's pretty clear what I meant to say. So the big question is, should you buy them? The downsides and the risks. Well, you should not always buy a Cannibal stock. The buyback of shares is often used to offset dilution caused by employee stock options. Many companies, they like to reward their employees by giving them stock options. This will increase the amount of shares that are available. So if the company is buying back shares, it might be just to compensate for that. That is not a real Cannibal stock. They are creating just as much as they are eating. So that's not the category we're looking for. It's also good to know that even though they're buying back shares, they're not investing that money into the company. So the growth of the company might be limited because of this. So it's good to have a look at that. Are they getting the maximum out of their profits? And it's also not good if the only reason the management is doing this is to increase their earnings per share, because that's what their incentive is. Have a look if the motives are good and if they are using your profits, the profits of the company, to the best advantage, not just buying back because that will serve them. Another thing to look at is if the company is getting more debt just to buy back shares. This might create a lot of leverage, which might make the company a lot more risky. So make sure that their debt management is good and they're not just creating it to buy back shares. So in which situation should you buy them? What are the prerequisites? Well, first of all, the profits should not decrease, and preferably they grow. In the example I gave earlier with the profits of $1,000, the profits were not increasing. But while the amount of shares were decreasing, if the profits are also decreasing, then the earnings per share might stay the same or might even go down. So it's good to know that the company is not deteriorating faster than the amount of shares is going down. So at least look for a company where the profits are staying the same, but preferably they grow, because that gives you a double effect. The profits are going up and the amount of shares you have to divide them with are going down. But the most important thing is that the stock should not be overvalued, and that's the magic of investing, trying to find out if a company is overvalued or undervalued. If it's clearly overvalued, then buying back shares will make you pay way too much for those shares. So then it's not a good way for the management to spend the money of the company. So have a look at that and make sure that before you go for a Cannibal stock, that the profits are not decreasing and that the company is not overvalued, so they're not overpaying for the stock. Well, we're already at the end of the video. I hope you learned a little bit about Cannibal stocks, and it will give you some insight into a part of the stock market. I'm also still exploring this topic myself, so if I find out more, I will share it with you. I would like to thank you for watching the video. If you have any more questions, please let me know. I would really appreciate it if you could subscribe to my channel. You'll stay updated with upcoming videos, and it will just help my videos to reach more people. So please help me out. Like and comment if that's what you want to do. And thanks for watching. I hope to see you next time.